Everyone, this is our latest meetup video that we had not too long ago in September. I hope you enjoy it. If you're looking to talk real estate or want to connect with me, feel free to reach out.
So thanks, guys. I really appreciate the opportunity to talk to you here. Let me share my screen. And then if you could let me know once you see it. You able to see my screen okay?
Yep.
All right. So, and let me know if you need me to speak louder, I will. So basically, I'm going to go through I focus 100% on multifamily. That's all I do now. I'll kind of go through kind of what we've been buying, why we've been buying it, go through some ways if you're interested at some point in time getting interested in a syndication, some of the ways you can get involved in that and basically add value to some other people. So I'll kind of just start a little bit brief about myself. I started buying small multifamily 26 years ago. I was a senior in college. Was CPA for a while, IT consultant, and did a couple other entrepreneurial type jobs, IT business that I started in 2008 as well. Full-time real estate investor now, all multifamily. I don't do anything else. Started buying large multifamily about 5 years ago. We purchased actually about 5,500 units. We currently own about 45 because we sold about 1,000 units last year, and we have an additional 1,500 units right now under contract. We're in 5 states in the U.S. And then, the first couple of years, we bought about 1,000 units, and then we bought over 4,500 units in the past 3 years. And people are like, well, that's a lot of extra units, in 3 years, and kind of what changed. And I'll kind of talk through what changed for me, which allowed me to kind of start doing larger businesses. And my thing, 2013 is when I started looking at syndication. Before that, I was actually buying properties with I have a twin brother. We were buying smaller multifamily. I didn't even know what syndication was when I started 26 years ago. I'd never heard of it until 2013, but it made a lot of sense to me. I always loved real estate, generally speaking, and multifamily in particular because it's a need that fulfills a basic need of shelter for people. But again, I was buying small properties first, and then my IT business was doing pretty well in 2008 when I started it. And really what transitioned for me was I had projects kind of all over the world. I worked about minimum 80 hours a week. 85 to 90 hours a week was pretty common for me. I'd sleep about 3 hours a night consistently, like day after day, 7 days a week. I had a wife and 2 kids, and it caused a lot of issues for some reason, never being home. So my wife was kind of like, you need to do something different. And that's how we transitioned into looking at larger multifamily. We looked at everything. We looked at franchises and self-storage and assisted living and landed on multifamily. But if you look at kind of the way, why this isn't clicking down here, traditional syndication, really people, and we talk to people all the time that follow the same structure, and it's what I was doing. I was trying to find the deals, trying to analyze the deals all myself, putting earnest money down, with typically about 1% of the purchase price for deals that we buy, signing the loans by myself, which would limit me. So when we get loans here in the States, the lender typically wants your net worth to be 100% or more of the loan amount, kind of a general rule, and 10% or more liquidity after you close, and then raise money. So I was kind of doing this all kind of on my own. And then I'm like, well, there's probably a better way of doing it. It took a while to figure it out, but we have a concept, just called family syndication, where we have there's a lot more people here. There's about 90, a little over 90 people in our group right now, I guess, and everyone works together, frankly. So some people just want to analyze deals, some people want to just find deals, some people just want to raise money, and some people want to do it all. But the whole idea is that you don't have to do it all by yourself. You're probably not good in every single area. Probably have a strength somewhere that, if you're analytical, you're probably going to like, deal analysis and maybe not as much raising capital and things like that. If you're more of a, marketing sales type guy, you're probably going to like raising money more than maybe analyzing deals. So whole idea is you don't have to do it on your own. You can kind of come together. We're able to collectively come together for loans if we need to as well, consolidate net worth, liquidity, and we're also able to reuse that. So one of the biggest differences when we start looking at doing larger multifamily deals, and that's considered commercial, is going to be 5 units or above from a lender standpoint, is the loans are non-recourse, so we don't have personal liability unless we do something, unethically, or fraudulent, things like that. We're also able to reuse our net worth liquidity over and over again for loans. So we never get tapped out. We can keep using that again. So really just people working together to go bigger, less painful, go faster, and do bigger deals. And we like to have fun, so we're very much community, family environment. We do a cruise and things like that as well with people in our group just to kind of hang out and have fun. There's some deals, just sample some deals. We bought 4,500 units the last 3 years, about 275 million purchases. Those are just some sample deals there that we purchased. And really a lot of it was certain pieces. I didn't do every piece on my own. I was doing pieces of this and getting involved in the deal by adding value to other people. I just put this, I'm not going to read the whole thing. I just put one thing in red up there. This is Jen. We met her a couple years ago at a conference. And we were talking to her, and she said she wanted to buy, single family and a duplex, things like that. And I just asked her a question, why don't you look at buying, 100+ unit deals? And I want to see what her reaction is. But, she says at the time 100+ unit apartment investing seemed super daunting. But actually, quickly after, in our group, she got into a deal, over 136 unit deal. So it is a mindset thing. But reality is, if you go back to the previous slide, is that you don't have to do it alone. That's how people are able to do larger deals. That was the first deal I bought that was on any of significant size, 64 doors. I partnered with somebody on that deal as well that had more experience than me at the time, but that was the first deal that we bought. So how do you add value? I have calls all the time, and people will say, well, hey, how can I help you? And generally speaking, this isn't to be critical at all. Lots of times people, they don't have a lot to offer yet. And that's okay, but they need to find a way to add value to other people, right? And I'm going to go through different ways you can get involved in a syndication and not have to do it on your own. So if you look at the different aspects of it, you can find deals, analyze deals, put earnest money down. We have people in our group that put earnest money down on a regular basis for other people's deals, and they get part of the general partnership for that. Sign on a loan. That can be net worth, liquidity, and or experience. I've signed on a loan before where they didn't need any help with net worth, liquidity. All they needed help with experience. So I signed on that loan, got part of the general partnership for doing that. Raise money, and then asset management, kind of overseeing the third-party property management company. The ones in red, the asterisks, I put them up there really in asterisk because a lot of people will say, well, I don't really have much capital, I don't have a lot of net worth, and things like that. Now, it's always easier to do almost anything if you have money. Reality is, that's true. But you can have examples of people that are doing things. Patrick Duffy, who we helped buy 4 deals in 1 year, 27-year-old guy, quit his job. He found deals and was analyzing deals. He didn't have money for earnest money. He didn't have any experience for signing a loan. He didn't raise a penny in any of those deals. So he didn't really have any money, if you want to say, to his name, but he still was able to get into deals. So the ones in asterisk are the ones you can technically do without having any money on your own. So I just go through examples, just kind of, finding deals, right? So this Brent Kawakami, he's done 2 deals in pretty well a short period of time. Both were 100+ unit deals, and I had made introductions to him for brokers, and now he has his own. He has great reputation with those brokers now. He just closed a deal about 5 weeks ago with that broker that I introduced him to as well. So he's starting to build his own track record and get experience on his own. He's still in our group, but analyze deals. So Eric Bolin, he started with small multifamily, still owns small multifamily, but did it kind of all on his own, self-managed at one point in time as well. But he got really good at analyzing deals. He kind of has a economics background, got good at analyzing deals, and he was brought into 2 deals as a general partnership, a total of 450 doors, just by becoming good at analyzing deals. Earnest money, Josh and Emily, I think they've done maybe 6 deals now that they put earnest money down, and they get part of the general partnership for doing that. That money, if you want, can be returned to you at closing as well. So you put earnest money in, close the deal, get your earnest money back, and you're still in the deal as part of the general partnership. Sign the loan. Paul, I think he's probably in our group 2 months and then got to sign a loan, and he came into a deal for his liquidity. We didn't need him for experience. We didn't need him for net worth, but we needed him for liquidity. Lenders won't count earnest money that you have out as liquidity. So there might be 3 or 4 deals that I have earnest money out on deals, and then the lender will not count that as liquidity. So Paul was brought in to fill that need. Rafi, interesting story. So, and I'm going to talk a little bit about this later as we go through too, about foreign money. Rafi lives in Israel. He's a one-on-one coaching student as well. He's raised, I don't remember now, it's a couple plus $1 million in a pretty short period of time, but his first deal he raised $850,000 in 2 weeks, with really not having his own track record at all. Kishan, he's raised about $3 million in 16 months and 7 deals. And again, he had no idea that he could even raise capital. He never raised a dime from anyone for anything before that. Couple examples here. This is a Clearbrook 144 unit deal. It's in Memphis. And just to put it up here to illustrate kind of the whole concept is, Justin and Aaron, far left, they found the deal. I made the introduction to a broker relationship that I had. So they're able to kind of get that kind of instant credibility. They put the earnest money down, Justin and Aaron did. I signed the loan for net worth, liquidity, and experience. Reality is Justin and Aaron, we didn't really need them to sign the loan for anything, but they were able to sign on to get experience on their own. And then people that raised money and investor relations, there were, like 6 people involved in that. So there's some legal rules, SEC rules in the States, how we have to follow people raising capital for deals and things like that. I won't go into a lot of details on that, but those are people that contributed by raising capital. This was a recent deal, 136 unit deal in Atlanta. Rafi and Brent found the deal, earnest money, they put it down. I signed the loan, Josh signed the loan for liquidity, and then Brent signed the loan as well. Then other people, this was an interesting deal because Rafi and Brent had the deal. I was also a general partner in it, but they brought in 4 other people in our group that were newer to the group, and they brought them in so they could participate and see the deal. They went through due diligence. They were getting email communications from lenders and title companies and things like that, so they could learn the entire process. Rafi and Brent didn't need those 4 extra people, but they brought them anyways just so they could learn. And then we had a number of people there that brought capital through their investors as well. I think this is a little outdated, but this whole concept of people coming in, and all these deals have more than one person that came in and helped in various areas. I think about 170 million. That was last year. We're more than that this year. About 2,500 units is how many units we bought our first year of doing this kind of family syndication model, and this year we're past that. So people will ask, how can I add value? And we talk about some of the ways you can add value, but there's more than just adding value too. You start building your track record. You can go big, fast if you want to. I tell people at least understand the ways you can get involved in deals, become educated, and decide maybe it's not for you, but at least understand the different ways you can get involved. And if you can start adding value to other people, you will literally start getting seeked out by people. People will call you. They'll reach out to you at events. They'll email you, LinkedIn, every form or fashion. People will reach out to you on a daily basis if you get good at certain aspects of this. you want to attract other people, get really good at something that is valuable. So this is where you kind of talk about being specialist versus generalist. And I think you want to have a very good, solid understanding of all aspects of multifamily investing, but get really good at something and become a specialist in that, and then offer that up to somebody that needs help in that area. And we see it all the time. A guy in our group that he's been in for quite a while. He's been very successful. He can analyze deals really well, but he said, I don't have time to keep analyzing all these deals. So he brought somebody else in the group that's newer, that's good at analyzing deals, and that person now analyzes deals for him. And the one that analyzes deals will get part of the general partnership if deals close. So he got really good at analyzing deals. He doesn't have to go out and find his own deals anymore. So, having something of value is not always enough. People want to, do business with you. This might sound kind of obvious, but I'll say it's a very, very small world in multifamily. Everyone kind of knows each other. And I have examples of people that, frankly, I won't do business with anymore just because they don't have this win-win mindset. We had a situation where we were kind of in a bind. We had 4 deals going on at once. We wanted help on some capital, one deal, and we offered something that was, very attractive. And this particular person kept pushing it and pushing it, kept asking for more and more to where it became so unreasonable. It was quite ridiculous. So now I will never do business with her. And it does come back because someone called me, wanted to know if I would invest in a deal, and this particular person was involved in the deal, and I told them no because of that experience I had with them, So it's you have to have a win-win mindset for sure when you're doing this. I'm going to show you some ways you can get good at raising money, really with no experience. Okay, and I say no experience on your own. So 3 mistakes that I've seen people when they're raising money. The first one is they start with no list. So might sound kind of odd, but there are people that will be like, well, should I get a deal first and then start raising money? Should I build my list first, then raise money? There's no question you have to have a list in place of people that are been vetted and qualified before you start trying to do a deal. You just have to do that. And there's different ways of doing it. You can have your own website with like a lead magnet. You can get on social media. You can go to events, things like that. Number 2, they wait until they get a deal, right? So you just can't wait that long. If you do, you're not gonna be successful in a deal. So don't start to raise money, right? You need to start building that list and start getting people in the mindset of this is what you're doing now. So we talked to a lot of people that they're wholesalers, they're flippers and things like that. And I tell them you need to start kind of educating, kind of conditioning your list of people that you're actually looking at doing multifamily now as well. So they understand that you're actually going into that area. That way, when you have a deal, it's not a surprise to them. Another mistake is pitching a deal. When you don't have a track record. So people say, well, I have friends, family, stuff like that. Generally speaking, even friends and families won't invest with you. I have people that are in our group that say that their dad, for example, will say, I'm not going to invest with you because you're new to this. So pitching a deal with no track record on your own is really, really difficult. So when you're talking to people that are potential investors, I mean, you guys are all there, so you're spending time. You could be doing 1,000 other things, right? But when you're talking to people, be real, be authentic, be vulnerable. It's okay to share, things with various people. If you look at things where you have common denominators, it doesn't have to be your own. But I can tell you about a lot of podcasts. Sometimes, truthfully, I don't really remember what I said on a podcast. And someone will reach out to me and be like, well, you're on the podcast, you talked about wherever. You grew up in Michigan, or you went to Michigan State, or you're a CPA, or you support missionaries, things like that. So people literally will just reach out to me because of that. And then we have the whole thing where it doesn't even have to be things that I'm doing. If I talk to somebody and they're into dance or their kids into dance, it becomes a big thing for me because my daughter is into dance heavily. My son's into guitar and motorcycles and things like that. So finding those common denominators, people like to talk about, themselves sometimes, their kids, and having that common denominator with them is really good. People want to do business with you that way. Be a connector. It's okay. It sounds strange at first, especially when you're trying to raise capital. It's okay to make introductions to other people. So I'll have people that reach out to me and will say, "Hey, I'm also looking for self storage or mobile home parks, stuff like that." And I make introductions. I can look at that and say, well, maybe that's taking money away from an investment I have, which it could be. But I make the connections. I introduce people to other people on a regular basis. You need your elevator pitch, and I'll talk about that further as well in a few minutes here. Understand their goals. So don't just assume just because, the way you think of an investment is the same way somebody else thinks about it. Somebody might be where they're needing cash flow. Maybe they're okay not having any cash flow and they have a big, huge value add deal that with no cash flow for 18 months. You need to understand each individual investor's goals because that's your deals you bring have to be a match to the goals of the investor. My partners and I, so if you're a limited partner in a deal, so you invest passively as an example, and or you have a partner that has experience. When you're talking to brokers, talking to investors, things like that, you want to be able to say, hey, my partners and I own whatever, 2,000 doors. That's a lot stronger messaging than you kind of saying, well, I'm new to multifamily. I can tell you brokers will not sell as a general statement, and sellers will not sell to somebody that's brand new. You're looking, let's say, for a 100-plus unit deal. They're not going to sell to someone brand new because they have no confidence in their ability to close a deal. So having somebody else's track record you can rely on is critical. Don't pitch deals. Build relationships, right? So your first thing out of the gate shouldn't be, I have this deal. I'm wondering if you're interested in it, right? It can take a while to build relationships. Be conscious of the person you're talking to. Some people really are, all they want to talk about is personal stuff first. I've had other conversations with people that I'll ask them questions like, hey, do you have a family? Do you have a wife? Do you have kids? Yeah, I do. And they completely bypass that. And they start talking about, real estate or the deal, things like that. So know your audience. In that case, you might not talk much about personal aspect because the person probably isn't interested in it. So be aware of that. So how do inexperienced people raise money? I'm going to go through some things here, and part of this came from Keely Hubbard, who's in our group too, is phenomenal from a sales perspective and everything, and just there's a big difference the way people used to sell versus the way people sell now. But mindset, right? I'm doing others a disservice if I don't talk about what I do. I talk to people all the time, never heard of syndication, never even knew or dreamed they could invest in a 100-plus unit property, never heard about it. Never knew they could invest through their 401k or their self-directed IRA. Never knew they could invest through their, it's called infinite banking, is example, a life insurance policy that allows you to use it for infinite banking. So talk about what you do. This is also going to help people to start conditioning them that you're actually, if you're doing multifamily, that you're a multifamily person now. You're not just doing things like maybe you're an engineer, maybe you're an IT guy. Well, you want people to start recognizing you as something other than just that as well. Leverage someone else's story and track record. I touched on that already. That's going to be critical as you start looking, if you start looking for deals that are of any size. You really need somebody else's track record to rely on. I just not going to read this as well. I just put it in there. Jen, she originally looking for deals, right? That's her. Everyone's mindset. I'm gonna go find my own deals. And I told her, other people told her that a good way to get involved in a deal is to be able to bring capital to a deal, whether that's money that you have from friends and family. And she said, I think less than 2 weeks after our event, she was invited to help on a deal, and she was able to raise some capital for that deal. the thing is that she was able to leverage a track record of somebody else that had a lot more experience than her. And if she struck out, which it's not ideal, obviously, to strike out, but if she did, she wasn't striking out on her own deal. She was helping somebody else on the deal. So it's a great way to get involved.
Mark,
Yes.
Was it you that brought her on to the deal, or was one of your partners that brought her in on a deal? If you don't mind.
I was a general partner in that deal, but and this is kind of a cool thing. Rafi and Brent are two guys in our group. They voluntarily brought in 4 people. Jen was one of them. We don't dictate things like that. Don't even necessarily tell people to do it. They just decided to do it because they want to give back to people, which is pretty phenomenal because it's a big distraction and a time suck for them. So they brought her in, and they're the ones that spent the time. She's a coaching student of mine as well. So she did reach out to me, in particular, a lot of things about raising money and about investor docs, but they brought her in. Other guys did.
Thank you.
Yeah, you're welcome. And then, so how do you answer the question, so what do you do if someone asks you that? And you can't be like, well, I'm a multifamily investor, right? Or multifamily syndicator. You need something different. So you need a one-liner, right? So you can kind of go through kind of what the one-liner should include. And for some reason, I don't know why, just so you know, there's like a delay on my part sometimes going from slide to slide more than normal. So it might take me a couple of seconds to switch slides sometimes. But, create a one-liner. You have a problem. So, what's the pain point? Right? Someone's not going to move unless they have some sort of pain. You think about everything, right? That you do. It's usually because you have some sort of pain point. And you say, "Now I need to change. I need to take action." So you need to have some sort of pain. What's your unique resolution to that pain point? How does their life look after their pain is resolved? So transformation. You hear some people also talk about kind of like the heaven and hell aspect where, okay, you want to say this is their hell that they're going through potentially, and this is their ultimate heaven that they can get to. So it's that transformation. They have a problem, you have a solution, and what does it look like for them after their pain point is resolved? Just as an example, if you take those 3 things, this is something we have on one of our pop-ups. We help working professionals quit their jobs in 3 years by investing in apartments so they can spend more time with family. So kind of the pain, the unique solution, and then what does it look like after they do that. So I would just encourage you, no matter what you're doing, whether you decide to ever do multifamily, whether you decide to syndicate or not, if you're looking at different things to do, it's good to kind of go through that, that problem, solution, and then transformation. So here we have, what do you want to do? You want to exchange information. You want to do phone calls, face-to-face meetings, and then incubation. So let's say, for example, you're at an event. So now we're going to exchange information. Your outcome, you should have an outcome when you go to an event. One of it's probably learning, but you're going to spend time at an event and money typically. You want to also get an outcome of meeting new people and getting business cards, for example. Get 5+ cards. I would say this is a balance act, right? You don't want to be the guy, and this has happened, no joke, at events we've been to, a guy standing at the door on a break handing out his business card. There was a guy at an event about 2 months ago in Dallas that had his fake business card on front of his t-shirt, in the back he said, "You need my business card." That's not, people aren't attracted to that, frankly, in my opinion. So get in though, meet people, remember some of the things, common denominators, try to find out kind of what they're doing, have your one-liner, and get some cards, okay? Find someone that knows other people. So let's say you go to a new event, a new meetup, and say, it's okay to say, hey, it's my first time here. I really don't know anyone. Do you mind introducing me to people? This is where I actually had this at an IT event. I used to do IT, and now this was an IT guy that I met with, and he was interested in real estate. He took me around probably about 15 people at the event, introducing me to other people about real estate. So I didn't know anyone at the event. So he was able to introduce me to other people. So phone calls. In between there, I would suggest probably doing an email too, if you want to. It's up to you. You could do an email exchange and just say, hey, I wanted to maybe jump on a call with you, talk further. I met you at the event, wanted to catch up more. But let's assume now you're on a phone call. Your outcome for the phone call is to get a face-to-face meeting. Okay, that's what you want to be able to do. Now, if you're not, in the same location, then you might have like, okay, well, maybe you could say, well, we'll have another phone call. Maybe you could do a live call through, Zoom or similar meeting tool. Remind them where you met. I get people call me lots of times like, oh hey, yeah. They give me their name. I'm thinking like, I don't know if I really remember them. So remind them where you met. So that's a good thing. Be natural. You don't have to be polished. The guy that's a super polished, slick, if you want to call him salesperson, things like that. I'm not attracted to that, and a lot of people are moving away from that. People don't like that type of sales anymore. So just be natural. You don't have to be polished. It's okay to make mistakes. Then you want to get, ultimately to a face-to-face meeting. And again, you want an outcome. The outcome here is to qualify them. Are they really a valid investor or not? Or do they know other people that might be investors? But, it's always easier to meet someone face-to-face. You start building relationships that way. And people will be attracted that way to people because they're able to connect with them easier. Give them permission to say no. You're not you're not going there to try to pound something on them or, it's okay to say, hey, if I say something or I'm bringing up a deal or bringing up different aspects, totally okay. Just let me know if it's not something you want to discuss. That's all right. Don't start pitching them on opportunities or features and benefits. This is more just, understanding them more. Let them talk more than you're talking, and then ask questions about what they're saying. Your whole idea is to figure out what they've done before, what are they invested in before, what do they like about it, what did they not like about it. Are they going to continue to invest in the future? And at some point in time, you want to get an idea how much. You have to kind of play that one to see whether you really want to, some people think that's a little more personal question. You could pitch it more like, most of our investments are a minimum of, $50,000 or $75,000 and kind of see what their reaction is. They might say, well, I don't have that much money right now. That's when you also want to go into, well, do you maybe have an IRA? Do you maybe have a life insurance policy that allows for you to borrow against it? Do you have things like that? 401k you can borrow against, but don't start pitching deals to them yet. Discover their pain. They're going to probably have, a lot of us have similar pains. It could be, I don't have time, I don't have enough cash flow. I've invested in the stock market and it's a roller coaster and I get stressed about it. Makes me sick to my stomach. I want to be able to provide for my kids and I don't have the means to provide for them. I want to give them a better life, things like that. Understand what their pain is first. And then discuss money in their decision-making process. How do they make decisions? What is it based on? Is it, do you and your spouse typically make decisions together? You kind of want to know who are the decision makers, right? Typically, for a lot of people, it's going to be, both spouses making that decision. And then discover potential concerns early and talk about it. Right? If they're like, well, I'm concerned I'm going to lose all my money. I'm concerned that the deal is going to go bad. It's okay to talk about those things. People much rather, when you're talking to people about deals too, and people ask me, well, Mark, what are your concerns with the deal? Every deal I've ever bought, I have some sort of concern over. I've never had a deal yet I bought where I don't have some sort of concern. So it's okay to share concerns with potential investors. It shows them you're being transparent and that you also kind of sitting in their shoes that, hey, there are concerns around this deal, right? Something could go wrong. Yes.
We have a couple questions.
Yeah, sure. Yeah, absolutely.
Hi, strange voice. You can't see me in the room. Maybe hi.
Hello.
How are you?
Good. How are you?
Good. I'm gonna interrupt you real quick. Are there certain questions that you'd like to ask to bring out those concerns in a subtle manner?
Usually, if you find out what they've done in the past, you'll find out about it. If they say, well, what's that?
Could you give me a sample? Sorry.
Yeah, if someone says, well, yeah, I've invested in the stock market and it's a roller coaster, so I get concerned because, I can't provide. Or they'll say, I've never invested in real estate before ever, and I'm concerned that the market's gonna turn, right? Is it, or I was at the top of the market in multifamily, so I think I'm gonna sit along the sideline. So having response to those, like that example where, hey, the market's the top of the market, it's okay to say, yeah, I think the market's gotten pretty heated up here recently for sure. That's why we're looking at other markets that make more sense to buy in than we were buying in before. If you look at certain things, everyone needs a place to live, and there's some things you should know, right? By 2030, there's another whatever it is, 4.7 million apartments that are needed in the U.S. And you can go through other things. You don't want to just spew off everything, but it's kind of like occupancy was still at the low side during the recession with 92% in the properties we buy. We buy B's and C assets. Fannie Mae, as far as on their foreclosure rate, was less than 1.5% in multifamily, where it was sky high on single family. So typically what they've done before, they're going to start talking about where they invested before, what they like about it, what they don't like about it. And then it's going to be, everyone's going to have the same concern. Well, if it's new, they have a concern because it's new. And then they're going to have concerns around, well, what happens if the deal just completely goes south? And if you have, information that you can kind of spew off a little bit, it's going to help, because these are facts, right? These aren't things that you're making up. These are facts about Fannie Mae and about the occupancy rate and things like that. People think the recession is going to come and no one's going to live in apartments anymore. It's simply not true. We had a bad recession here in 2008 through 2000, close to 10, and still BC assets, 92% was the low for occupancy on average. It's still high. And then you can go through things. We look at a lot of different aspects before we buy a deal. We look at things like break-even occupancy, break-even rents. We do sensitivity analysis to make sure that we're able to, pay our bills and pay investors and things like that. But generally speaking, it's going to be based on what they've done before, is where the concern is going to come up.
Okay,
that answer? Yeah, go ahead.
Sorry. The reason I'm asking is because I used to work in the car industry, and there are certain questions, that you can ask, and sometimes with the right amount of rapport, generally speaking, people will bring out their damage to you. If you get what I'm saying.
Yeah, people share a bunch of stuff. I mean, some people are very tight-lipped. Sometimes it's cultural too. I mean, not to be, there's certain cultures that don't share as much. They just don't, as a general statement. But if people see you sharing stuff and you're sharing like concerns, you're sharing like, things about, they ask you about the deal and you share a couple of things that you're concerned about the deal. You just have to say, hey, I love the deal, but every deal I've ever bought has some sort of concerns, and here's the concerns I have. It shows you're being vulnerable, you're being authentic. But like I said, usually it'll come out if you met, this is probably your second time meeting them now as well. They're gonna tell you, they know ultimately what you want to do, that you want them to invest in a deal, just like buying a car, right? They know ultimately that you're gonna want to, your sales manager's gonna come out and harass them, to try to get the car, So, and with the sale, same thing. It's your spouse. Concern could be, hey, is your spouse on board with this? And they say, well, no, I haven't talked to my spouse. She or he really doesn't really know if I should be investing in this. And then you can say, well, I'd love to meet with them as well. And I've done that many times where the spouse, usually it's phone, spouse gets on the call as well, and it helps, frankly. So just kind of give. Every angle they have, you're like, you have a solution to it. I'll talk to them, or I'll, like with his cars, we call your spouse right now and ask them, right? But I don't know if it really answers the question, but I can tell you concerns will come up for sure based on what they've done in the past.
No, that's beautiful. That answers everything. Thanks.
Was there another question too?
I basically had the same question, so
good.
Thanks,
perfect. Okay. Yeah. All right. So that's face-to-face, and then I put this on here too. Listen more than you talk. A lot of people like to talk. Frankly, they do, right? End of the day, having them talk and you just listening uh, it shows, hey, one, you're engaged with them, and two, they're gonna be able to tell you more information about them and things like that, and pick up on it. I mean, when we do events sometimes too, when I meet someone beforehand and I remember something like, hey, the person was, whatever. I remember their name, and I remember like they have a couple kids, something like that. People are pretty shocked sometimes when you're at a huge, bigger event and you remember certain things about them. It really makes them feel kind of, if you want to say, kind of special. But let them talk, pick up on things, and then after you don't want to be taking too many notes there because it sometimes looks like you're not paying attention. I usually always take notes on my phone. I don't write anything anymore, and that can kind of look. So be cautious about that because it might look like you're texting or not really being engaged. If you're going to do that, I would say, hey, do you mind if I take a couple of notes? This is really important stuff you're kind of going over. I wanted to maybe make sure I capture it. And then put notes in there, too, when they're telling you have two kids or 12-year-old and 14-year-old, boy, girl, things like that, people. And then you can, next time you talk to them, you can bring up these things about them. So, again, with the track. This is, if you get a yes, I'm sure this was in the car sales business too. I don't know, but if you get a yes, stop talking. This is bizarre. I've seen this actually go south. I really have. People are like, I'm in, and then people are like, yeah, and I think we're gonna do this to the property, and I think maybe, and they start. Then it's sometimes like, what are you even doing, right? So if you get a yes, it's good. Hey, that sounds great, and I'll let you know when the investor documents are ready. And just stop there. You can go then start talking about personal stuff if you want to, but don't keep viewing at the mouth. I have a partner that kind of falls into this sometimes, and I've told them before, just stop when they say they're in, stop talking. So, but incubation, this can be, you want engagement and you want to add value. This could be, I'm gonna put a couple things up here. You can do kind of as little or as much as you want. This could be, I got emails, addresses. I've gotten face-to-face with people, but even on the email addresses, I've gotten, maybe phone calls. I want to put them in some sort of email campaign. It could be you do monthly newsletter or quarterly newsletter. Some people say, well, I don't really have anything to say. I'm new. Well, reality is it can be a combination of your personal stuff. It can be. And you're learning something. You probably still have more knowledge than the average person that knows nothing about it. You could come up with your own, 10-step checklist before you invest, or 5 mistakes I made in investing, whatever it is. And then you can send that out to people, put it on your website. You definitely, in my opinion, want your own domain on your website if you're going to really be doing this. Have a lead magnet with a pop-up that people get that you say, hey, give me your email address and your name, and we'll send you this free ebook, whatever it might be. You can put it on social media, the same thing. We could do weekly, daily, 2 to 3 minute videos on a certain topic. In my opinion, daily is a bit excessive. There are a lot of people that teach this. I'm not convinced daily is a good thing. That's just my personal opinion. I don't want to see somebody every single day doing a video. But I'm busy. Most people are busy. Keep it short, 2 to 3 minutes, and it needs to be something of value. And we had, and just as a simple example, someone in our group reached out 2 days ago about like a sub syndication. So they want to syndicate on their own for another person's syndication. It's a great 2 to 3 minute video. The pros and cons related to it. But again, I don't think you have to do it every day unless you want to. Some people might say, well, I don't really want to do live videos. I don't want to do. It doesn't have to be live. You can record it. Downside to not doing it live, Frank, I can tell you from experience that you might record it 20 times. So it takes a lot longer if it's not live because you're going to keep critiquing yourself and I should have said that but give value to people. End of the day, social media, great. I know a guy personally that had over 1 million people on YouTube and he got cut off from YouTube permanently forever. He's done. Never to be on YouTube again. So he has no access to the 1 million people that he had on YouTube. Social media is useless unless you have people's email addresses. You can't control who's seeing it. So you want something of value to capture the email addresses. Keep them engaged, current projects you're doing. Try to do a phone call every 30 to 45 days with people. Eventually this will become where you can't do this anymore. You get too many people, right? But maybe there's certain people that are investors and things like that you want to continue to do that with. And but your newsletter, social media presence, it doesn't have to be all business. Social media can be personal, and then mixed in with business, and then that's kind of how you engage people. You want to be engaged. Don't be disappointed or sad if people unsubscribe from YouTube, because eventually you get more and more people that are going to unsubscribe. Just realize that's part of the deal. But you want to communicate to people. So take massive action, create your one-liner and use it. So memorize it. Tackle that stack. This is so funny. Every deal or every event we go to, people gather business cards, and I'll go to different offices of people I know, and they have a stack of business cards. And I always talk about this. You need to follow up. If you can just follow up with people after an event, you're further ahead than 99% of people, because people just don't do it. So follow up with people, tackle the stack, make phone calls, and then if you want to film your first video, just pick some sort of topic that you know well. Can be 2 minutes long, can be 1 minute long, but do that. And again, these are kind of the different ways to get involved in a syndication. You can add value a lot of different ways. You don't have to be the expert in every single area. Then just contact information there as well. So I know it's kind of somewhat quick, kind of a lot of different things, but if you kind of summarize it, it's a lot of ways to get involved in a syndication if you choose to. Get really good at something, one or more things, and add value to other people, be easy to work with, and then start building. If you want to syndicate and raise capital, you have to start building a list, and you need to go to events like you're here at Meetup, which is great. You need to start going to events, capturing people's information, following up with them through email, phone, face-to-face, putting them in your incubation, and start communicating with them and start building kind of your list that way. There are some people that will invest right away, and there are other people. I have a guy that I've known for 3 years, and pretty much every deal I've done, he's like, yeah, I'm interested, and then he doesn't invest. So he just recently, in the last 4 months, invested in his very first deal after 3 years. So it can take a while. It can be frustrating, but if you keep doing it and follow up with people, you can start building a pretty big list and raise a lot of money. A little bit, because that's about the foreign investors. We brought money in. Maybe we meet somebody from China here recently here, but from Israel a couple times. And how do we manage those investors and things like that? There's each country is a little bit different. We have someone in Israel that's in our group. So if you can have someone local that kind of helps feed, that information to the investors out of the country, that's probably the best way of doing it. In this case, they speak Hebrew and things like that, right? That's what their native communication is. So just having that type of person in between is great. So that's really the only experience we have raising outside of the U.S. Right now. We're looking at doing more and more with that, but that's kind of how we've been able to manage it. And there's some other things like you have to consider, like the PPM, the investor docs had to be translated into Hebrew as an example. We also had to go through a third-party intermediary. They wouldn't wire funds to us directly, so that took a lot longer. We also had to wire funds to title. They wouldn't wire to our bank account. So there are definitely some more complications with it, but if you can get a fair bit of capital that way, it's a good way to do it. So I don't know if there are other areas you wanted to cover, and also any questions. I'm more than happy to try to address them.
Go ahead.
Yeah, hi. So I just got a couple questions. So how did you find your first deal? Was it through a broker, or was it through maybe marketing off-market deals?
We did. I'm going to get this screen bigger too. Do you know how to make the screen? Oops. I was going to try to make the screen bigger, but anyway, yeah, first one we got was 2 properties. So they were 2 32-unit deals, but only one of them was for sale. well, really, as far as listed, it was through a broker that we knew in Dallas. And when we met, we toured the property. The broker said, "Well, hey, there's actually the seller actually has a 32 unit like right next door. It's like 200 feet away. Maybe he'd be interested in selling that as well," which he was. But we got through a broker, and the reality is we continue to get almost all our deals through brokers. Now, a lot of the deals we get, like in Atlanta, we use a lot these guys, the Brown guys, for their deals, and half our deals there are off market. It doesn't mean we get a steal of a deal, but definitely less competition and a better deal in general. But we don't try to go direct to sellers. Not that you can't or that you can't be successful, but I would say if you're going to try to do that for 100 plus unit deals, it's pretty tough. And you probably should also build broker relationships because they're the ones that have the masses of deals. If you build a relationship with a seller and the seller, it happens all the time. A seller gets approached by a broker and then they list it with a broker, and now you're just like everyone else trying to go after the deal.
Okay. And then I just have one more. So how did you scale your business so quickly, like in 2 years, go from 0 to 1,000 units?
Yeah, I was pretty motivated, and that's not really, I'll get a little bit more of the answer. Motivated because it was, my, family was, issues were going on with my wife at the time. Now, thankfully, we work full time together. She's in the business 100% with me. But I was motivated, so I was working a lot, just looking at deal after deal. I analyzed tons of deals. I've analyzed well over 1,000 deals, probably, since my time of doing this, and also being easy to work with, not a pushover, but reputation wise, our reputation is really impeccable in the marketplace. And it's because we do what we say we're going to do. A lot of guys have this mindset, well, let me just get the deal tied up, and then once I get it tied up, I'll start going back and renegotiating with the seller. That's a bad way of doing it. We don't do that. So we've made a lot of transactions very easy for the brokers and sellers, and that's why we get a lot more deals. But it's trying to do. We've had people in our group do up to 6 deals in a year. That's a lot of deals. I mean, and they're all over like 100 unit deals. Doing a couple deals in a year that are 100 plus unit deals, I think is very doable, but it's still work. But for us, it was more just out there hustling. I mean, I looked at so many deals.
Okay. So you went from the 0 to 1,000, and then in the next 3 years you went to 4,500?
Yeah, we bought over 5,500.
So what people did you put in place to be able to achieve that? Or was it just you just built this community sort of a business?
Community. It was. Yeah, we started doing deals and started doing this whole family syndication kind of concept where I have people that find deals all the time in our group, and they don't have to partner with me. They're not required to. But if they want me to sign the loan, they want me to raise capital, I do that. So that's what's allowed me to really do that. And I also have a really good broker contact in the Atlanta area that brings me a lot of deals. He works exclusively for me right now. I also hired someone to find me deals. I don't use them anymore because we have a lot of deal flow. But I hired someone just to find me deals because I had the bandwidth to keep out trying to find them. But really allowed me getting more and more deals is that it's adding value. I mean, I signed on 18 out of 20 loans last year in the group, which adds value to people. I raised money on all those deals for people, helping them that way. They're able to leverage my kind of track record when talking to brokers if they want to. So kind of adding value through past experiences, loan experiences, and then really the broker relationships.
Mark, maybe
Yes.
explain the people how you're structuring the deals, like the general partners and the limited partners, and like how the equity is kind of split up on a deal like that. I think that'd be awesome for them to.
Yeah,
to hear
I'll tell you how
this.
we. Yeah, absolutely. I'll tell you how we do it. And it's pretty similar to a lot of people. So our deal structure, we take usually a 2% one-time acquisition fee based on the purchase price. So 2% of the purchase price can be 1.5, depending on how big the deal is. That's paid at closing. So the syndicators, split those funds that way at closing, which can be pretty substantial. especially on a bigger deal. And then we typically pay an 8% preferred return. All that means is that the investors get the first 8%. They're not capped at 8. Anything above 8, we split 70% to them, 30% to us. So 70-30 split. We don't do what's called a waterfall. Some people will have 70-30 split, and if they hit like a hurdle, like maybe a certain IRR or whatever it might be, then it might be a 60-40 split, 50-50 split. We don't do that, but you can. And that's pretty much, we take a 1.5% asset management fee of revenue collected for the month. So that's to oversee the property, do refinancing, oversee the third-party management company, things like that. That's pretty much the structure we've been doing pretty regularly over the last couple of years.
So how do you manage your investor relations?
We tool-wise, we started using a tool called IMS. I don't know if you guys heard them or not. There's other tools out there, but IMS is what we started using from an investor portal. Reports go out there, distributions go out there, their K1 tax returns go out there. So that's kind of, and then we on a monthly basis, we're sending out, a general ledger. We're sending out the profit and loss, right? The T12, the rent roll, balance sheet. So every month they're getting reports. With that on a monthly basis, we don't really get a lot of questions, frankly, from the average investor. You might have one or two on a deal that might have questions, things like that, but we don't get a lot of questions anymore on deals because the information we provide is pretty extensive.
Mark, when you decided to focus exclusively on multifamily, I know there's a lot of different options in the real estate space that you can go into. Why did you decide to focus exclusively on multifamily versus everything else? Is it simply just you're able to scale it faster, or just curious what your thought process was on that?
No, it's a good question. I mean, we looked at different area asset classes. The way I look at it is everyone needs a place to live. If you look at self-storage, like we had self-storage unit for 4 years. We paid like $200 a month, but we never went there. We really didn't, right? So it's like a lot of people. I like self-storage because you don't have to deal with toilets and things like that, right? I understand that, but if times really got tough, then we could sell our stuff in self-storage and not have that unit. But it's pretty hard. You move it into your house if you want to. But everyone needs a place to live. If you look at assisted living, same thing. If times get tough, people can have their parents move into, their house with them. If you look at from a loan perspective, we get all non-recourse loans, so we don't have personal liability. If you look at office, retail, stuff like that, you're going to get recourse loans as a general statement. We get the highest leverage in multifamily. It has the lowest delinquency rate for foreclosure, things like that. So I think a lot of those asset classes are really good. I invest passively in some other things. As a passive investor, I'm not an expert in them. I know enough to make an informed decision to invest in them, but I'm not the expert. But I think that with the way we can really improve multifamily, right now, every dollar we can increase our revenue or decrease our expenses, doesn't matter which one we do, it's $16 of value at a 6 cap. So literally, every dollar we get in revenue, someone else would give us $16 for it. So there are a lot of things like that that are more attractive to me. End of the day, if you're not going to live on the streets, you need a place to live. And there's certain areas and certain people that they're always going to rent. We buy a lot in Memphis, and I think the number is 70% of the people in Memphis rent. Right? They're not going to buy a house. A lot of them can't. So those are some of the reasons I like multifamily above some of the other ones. Although I do like a lot of the other asset classes too.
Awesome, thank you.
You're welcome.
I have a few questions. Chin here. How do you do your property management? Do you have your own company? Do you hire someone? Or do you use whoever exists in that building?
Now, yeah, we use a third-party company for it. It's typically regional based. So regional being, southeast U.S. is, for example, Texas, things like that. We're not required to use the existing management company, and rarely ever do we. But we use third-party management, and that's another thing with going larger. If you try to buy, 10, 20, 30 units, nothing wrong with that. But it is tougher to get professional management. The management companies we use typically will manage, 10 to 40,000 doors, so they're pretty big. They have their own accountants, they have their own, the whole staff, right, is there. Smaller properties harder to do that. So, but we use third-party management on all our properties. It doesn't mean that we haven't had problems with them, because we have in the past. But right now we have really, really good property management companies, but we've had to fire some before as well.
I do have another question about loans. So do you get the investor, you raise money to pay for down payment, then use the property to get loan, or each of the investors somehow get their own loan and bring in all the money, so this property doesn't need to get a loan?
So the investors, like the limited partner investors, are not on the loan at all. They have zero interaction on the loan. It's just going to be the general partnership, and it's really going to be the key principals that sign the loan. So you might only have, like one loan I'm doing my own right now, because the lender only wants me on the loan for some reason. I don't understand why, but they do. But I'm doing the loan by myself. The investors have nothing to do with the loan. They don't have any liability with it. They don't sign any loan documents. They don't see any of the loan docs at all. So does that answer your question?
So the investors bring in down payment.
Yes.
And they will use the property to get loan from the bank. So
that's right. And we're getting typically 75 to 80% leverage still on our the other 25, 20% or so will come from investors.
Any more questions? Well, Mark, thank you so much for joining in on the call there. I appreciate everything.
Thanks for having me. I really do appreciate it. And if you guys have any follow-up questions, just reach out to me. I'm more than happy to try to help any way I possibly can. I really appreciate the opportunity to talk to you guys.
I'll send your contact through to everybody there on the list that we have of our members.
Okay. No, it sounds good. Thanks, guys.
Perfect. Thank you again. I appreciate it.
You're welcome.
Have a good night.